Most accredited investors leave millions on the table because they skip one critical step in pre-IPO and private credit deals. Today, we are breaking down the exact due diligence framework that separates winning portfolios from catastrophic losses. If you are building a 7- or 8-figure portfolio with alternative investments, this is not optional anymore. The difference between a $10 million portfolio and watching your capital evaporate often comes down to the questions you ask before you write the check. Let's start with pre-IPO equity. Before you invest in any late-stage private company, you need 3 layers of verification. First, confirm the cap table. Who owns what? Are there liquidation preferences that put you at the back of the line? Second, validate the revenue model. Is this company actually generating cash, or are they burning through venture capital with no path to profitability? Third, examine the exit timeline. When is the IPO expected, and what happens to your shares if it does not occur? Now let's talk about private credit. This asset class has exploded in popularity, but the due diligence here is even more granular. You need to understand the borrower's financials at a forensic level. Request audited statements, not just management projections. Look at debt to EBITDA ratios, interest coverage, and collateral quality. If the borrower defaults, what are you actually secured against? Real estate? Equipment? Accounts receivable? The devil is in the details. Here is where most investors fail. They rely on the sponsor or the platform to do the diligence for them. That is a mistake. You need independent verification. Hire your own legal counsel to review the subscription documents. Bring in a CPA to audit the financials. If you are investing 6 or 7 figures, spending $5,000 to $10,000 on third-party diligence is not expensive. It is insurance. Let's discuss regulatory compliance. As of early 2025, the SEC has increased scrutiny on private placements. Make sure the offering is properly registered or qualifies for an exemption under Regulation D. Verify that the issuer has filed the required Form D. If they have not, that is a red flag that could expose you to legal liability down the road. Liquidity is the silent killer in alternative investments. Pre-IPO shares and private credit notes are illiquid by nature. You need to model for a zero liquidity scenario. Can your portfolio survive if this capital is locked up for 5 to 7 years? Do not invest money you might need in the next 3 to 5 years. Period. Finally, diversification within alternatives is critical. Do not put more than 10 to 15% of your total portfolio into any single pre-IPO deal or private credit note. Even if the opportunity looks bulletproof, concentration risk is how portfolios implode. Spread your bets across sectors, stages, and instruments. Here is your action plan. Before your next alternative investment, create a diligence checklist. Cap table analysis, financial audits, legal review, regulatory compliance, liquidity modeling, and concentration limits. If you cannot check every box, walk away. There will always be another deal, but you cannot recover capital you lose on a bad one. If you found this valuable, subscribe for more institutional-grade investment strategies. Drop a comment with your biggest question about alternative investing, and I will cover it in the next video. Let's build smarter portfolios together.